Hi, and welcome to the BizTech's Inside Trading Show. The show is all about trading. Every week, we discuss what trading is all about and the required habits for you to be a successful trader. All of this is about sharing trading ideas and helping you to make money. Now, with me is my regular co host, Pang Lung. He's the founder and CIO of Track Record Trading Academy. V, welcome to the show.
Hey Brian, it's good to be back. Let's talk about trading.
Now, V, great to have you on the show again. Today, we really zoom in about the risk in the economy today, despite the Fed not raising interest rates. Now, but before we dive deeply into that, we're going to start as usual with a quotation. And today it's from Jack Schwager. I think I got the pronunciation right. He's the writer of the book Market Wizards. And so, V, share with us what he says.
Okay, so he said the dangers of watching every tick are twofold. Meaning if you're watching the markets too closely, you're watching the uptick, the downtick, you're worried all the time. There's two big risks. One is that you will end up over trading, and the other is that it increases the chances of you prematurely liquidating good positions. So this is a problem that many traders have, not just retail traders, but also some professional traders, is that they pay too much attention to the short-term movements, and they try to be too cute. They try to overtrade. They try to exit, hoping to sell now so that they can buy lower. And in the end, they miss out on the longer-term trends. So it's much like why we have many friends who knows that Apple is a great company, Google is a great company, but very few are actually invested in it because they probably took 5% profit like 2 years ago, right? Something like that. Yeah.
Now, V, I want to move on to what I think on investors' minds right now. So the Fed did not raise interest rates in the last round. What
Yes.
is the impact going to be to us moving forward? What are bond yields and interest rates telling us?
Okay, cool. So let's discuss the Fed's message. The Fed's message was that they are on a pause right now, but they believe that they will hike at least one more time before the end of the year. That's the majority of the committee members believe that there's at least one more interest rate hike, but then that would be likely the last one, and they will keep interest rates higher for longer period of time. So they took away uh, predictions or projections of a 50 basis points cut next year, right? Like, so they believe that interest rates next year would be higher by 0.5% than they previously projected in June. But since then, what has the market done? On the red line you see here is the US Treasury bond curve, yield curve, prior to the Fed, and blue one is after. So you can see that's a big movement in the yield curve, right? In the 2 year front, it hasn't really moved much. It's gone up slightly. It's gone up 0.04 of a percent, which has gone up 4 basis points. But in the 10 year sector, the bond yields has gone up by more than 30 basis points, or 0.3%, and 30 years more than nearly 0.4%. So what
Now, V,
this
I want to
means,
stop you here because I want
yeah.
to address this to the audience that this is an unusual situation where there is bond curve yield inversion, which means the long-term rate is shorter than the short
It's
is
lower, lower.
lower than the
Yes,
short-term rate.
yes. This tends to happen when the historically it had tend to happen when the Fed is on an aggressive hiking cycle. So the shorter term interest rates shoots up, but the longer term doesn't really go up as much because they believe that eventually the Fed will control inflation, and likelihood also is that the Fed will push the economy into a recession, so they will need to cut interest rates at some point. So because of
So
the
this
Fed's
is the
message,
canary. So this is the
sorry.
canary in the coal mine in terms of a recession, always, isn't it? When we have bond curve yield inversion.
Well, historically, yes, but we have had this yield curve inversion for some time now. So I think it could be different. It could be different, but of course, these are very famous last words in the markets, right? That it's always going to be wrong when you say this time is different. but there were some structural factors which caused the term bond yields to fall substantially through the last 20 years. But I think it's possible that these factors are starting to unwind, and that's why we are now seeing the steepening of the yield curve. Steepening means that the back end, the 10-year, 30 years are starting to rise faster than the front end.
And now, V, you tell us about some of the impact really of foreign shareholding on treasury yields.
Okay. So first we want to explain why this is happening, right? Why is the bond yields, why are the bond yields rising, and why it should matter to us? First, it's rising because of the Fed's higher interest rates for longer message. So the markets are starting to price that. They're thinking, okay, if you're not going to be cutting rates and its interest rates anytime soon, then the longer maturity interest rates should be factoring this in. So it's starting to factor. But also many financial products, right? Any assets that you'll be trading, it's all likely due to the price dynamics. It's very dependent on supply and demand. So there's increasing supply of US bonds for the uninitiated, for the retail traders who are not sure what bonds are. They are essentially instruments where it's just an IOU that the US government issues to borrow money from the market to fund their budget deficits, right? So they need to spend, but they're not earning that much revenue to cover their spending bills, which is the case with the US for some time now. They need to borrow, so they're issuing an IOU. So that's a US Treasury bond, which is the IOU that they're issuing. And because they're borrowing more and more, then the supply of these IOUs are increasing. So that's pressuring the price, right? So, and that's falling demand as well. So foreign buyers, which used to be very keen on buying US bonds, are becoming less keen, and in fact, some are reducing their holdings as well. So,
and this is particularly a couple of, and we'll talk about that a little bit more. Couple of two key countries really are reducing their holdings of US treasuries.
Yes, correct. That would be Japan and China. But yes, as you said, we will discuss this in a bit. But the reason why the US government continues to borrow and borrow at ever increasing amount is that their budget deficits, the more that the amount they're spending continues to be substantially and increasingly more than the revenues that they're receiving. So if you see here on this table, in 2020 and 2021, the budget deficit rose to nearly beyond 3 trillion, and then nearly 3 trillion in 2021, because we know it's COVID, right? So they need to fund the shutdown economy. They need to give subsidies. They need to give unemployment benefits. But in 2022, that reduced substantially. It fell below $1 trillion. But in 2023, that doubled. So what we are seeing is that one of the reasons, of course, is they're spending on the war, but also they continue to need to fund more spending bills, and that's why they're continuing to argue on this recently. But with the US elections cycle, with the US election scheduled for next year, it's very unlikely that the government can rein in their spending, right? If you are trying to impress voters, it's not the time to tighten your belts. So it's likely that this budget deficits will continue to increase, and that adds to so it's not at 2 trillion. It adds to pressure on the need to borrow, so they need to issue more IOUs, and as a result, the prices of bonds goes down. And as we know, when prices of bonds go down, the interest rates implied goes higher. So rising US debt has been rising through the years. It's barely made a dent in and they never really fell except for brief periods of time in history. But right now it's like 33 trillion. It's 33 trillion, which is ever growing, and with interest rates at higher levels, they continue to have to fund their existing bonds, existing loans at higher interest rates. So it's also increasing their spending. So as is the case with many other forms of debt, sometimes you really need to refinance, especially when the loan comes due. So as of September, US debt totals $33 trillion, and an estimated 7.6 trillion needs to be refinanced in the next 1 year. And as a result, we need buyers for this, right? So they need to sell more debt, they need to issue more debt, they need to borrow more. But as you said earlier, there's two main foreign buyers in this of this US debt. Is Japan and China. As we know, they are the ones with the biggest current account surplus. They are the biggest savers in the world. But even their holdings have been coming off. The Chinese holdings of US debt is at a 14-year low. It's the lowest we've seen in this decade and the past as well, where it is now below $900 billion. The peak was 1.3 trillion, and for Japan, the peak is 1.33 trillion at the end of 2021, and right now it's slightly below 1.1 trillion. Yeah, so we are seeing a decline of foreign holdings. Between these two, they used to hold 25% of all US debt that's held by foreigners, and now it's just under 8%. So their holdings are diminishing, partly because for China is for both of them is partly because of the falling value of the US bond that they hold, because as interest rate rise, the existing bonds that you hold fall in value. So that's part of the reason why their values of their holdings are dropping. But it's also they are refraining from buying, especially for China. They saw the case where Russian central banks holdings of US assets were confiscated or frozen when the Ukraine war started, and then with US antagonizing China in the form of sanctions and restrictions on their imports of technology as well as semiconductors, as well as the very blatant and vocal description of China as a strategic rival. I think China will still be the propensity for China to continue buying, adding to this $800 billion worth of assets that they hold in US dollars is going to be very, very low. So with increasing supply and falling demand, we are likely to see pressure on the bond markets for some time. And if this continues, so as you said at the beginning, we are going to talk about the risk. Is trading is not always about the opportunities, but we have to be aware of the risk as well. And the risk is for the market is that even if the Fed continues, even if the Fed doesn't hike interest rates further, but if they continue to talk tough on inflation, on wanting to keep interest rates higher for a longer period of time, and with these dynamics that we are seeing in the US bond markets, it's likely that the US long-term bond yields will continue to rise, and that impacts the economy in various forms. Primarily, businesses will find it hard to borrow, and consumers will find it hard to refinance their mortgages. Mortgages are refinanced using longer-term interest rates, and we could see the housing markets slowing down and economy slowing down, and eventually, with interest rates at these levels, even if without any further rate hikes, we could see the credit conditions tighten further and the economy sink into recession in the months ahead.
Now, V, on a final note then, given the scenarios that we are looking at, which you've just pointed out, as an investor, how do we protect ourselves? Because obviously there's a lot of risk in the market. The safe option may be, and the really safe trading option is to sit on cash or to literally park your money in low risk instruments like treasury bonds.
Yes, not the longer term treasury bonds though. The
Yes.
shorter term treasury bond. But yes, it's I think the key to this is that it is not the environment to rush in and buy a lot of assets, even though it is likely that the Fed is nearing the end of their hiking cycle, right? So typically it would be okay to start to become more risk seeking, but I think there's quite a lot of risk on the horizon, risk factors on the horizon, and this is one of the things that we must keep an eye on. There's no need yet to rush into getting fully invested. I think the time will come when the global macro environment is more friendly to risk assets. But until then, I think we, as you said, keep a portion of your savings in cash and wait for opportunities before we deploy the capital, right? So again, back to this quote that we started, it's not necessary to be watching the markets all the time. It's more important to be aware of the risk and the opportunities. And when the opportunities arise, it's never too late to start to deploy aggressively then.
Now, on that note, V, that's it for this week's Inside Trading Show. V, thank you very much for your insights and thanks for coming on the show.
Take care. Bye-bye.
We've been speaking to Pang Wee Loong, the founder and CIO of Track Record Trading Academy on BizTech's Inside Trading Show. I'm Brian Fernandez. Check out this interview and show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.